Hey there, Nomads. Welcome back to another episode of the GPT Nomad Show. So today's topic, we are going to cover stock trading versus option trading. Right. So for many new traders, they may be wondering what is the difference between these two instruments. Okay, so in this episode, we're going to break down some of the points for you guys. So for the first one, is in terms of the ownership. Stocks trades for stock trader, when they buy the shares, they are going to gain the ownership of a company, right? So if you guys don't already know, company share represents a portion of the ownership of the company. So we are actually buying into a company to become a small owner, right? When we buy a share. But on the other hand, if you are trading the stock option, then we are merely buying the contract that allows us to buy or sell the shares at a certain price by a certain date. So in that case, we do not become the company owners, but we are just merely trading the contracts. So with that, it leads us to the next point, which is about dividends. So dividends are a very cool way of making money, right? Because if you hold the shares for a long time, then every year or every quarter, for example, the company may declare dividends and we would be able to collect some money, right, in our account without doing anything, right? Simply because we hold the shares, we are entitled to the dividends that they declare, right? So the money comes in. So that is the case if we are buying the shares, because again, we are owners of the company, right? So the privileges of ownership will include the dividends that we can receive as a shareholder. On the other hand, if we are trading the options, then it is a different case. So the holders, whether they are buyers or sellers of the contracts, they are not entitled to the dividends declared, right? Because they are technically not the owners of the companies. So then they will not be entitled to this lucrative, right, or this channel of making money. So on the other hand, right, for option contract, so the advantage of trading this is it allows us to use a smaller capital, right? So if you were to trade 100 shares of Nvidia, right, as of the time of recording now in August 2024, Nvidia is trading at around $120 per share. So if you were to buy 100 shares, that will cost us about 12,000 US dollars. Okay, so it's a relatively bigger capital, but if you were to trade the Nvidia contracts, then that is a different thing. Okay, so depending on the expiration date that we choose, a longer expiration date meaning a more expensive, it will be a more expensive contract compared to a shorter term one. So the price here, it could be a few $100 US dollars up to a few $1,000 for each contract. Every contract represents 100 shares. So we are able to control, right, or move with the shares, right, using a smaller capital. So if you buy 100 shares, then you have to spend $12,000 upfront. But if you have to buy the call options, it could cost us a few $1,000s at a fraction of the cost. And whenever the Nvidia shares go up in value, then percentage wise, we are going to earn more, right, when we trade the contracts, because we are using a smaller capital. So we can actually use the same amount of capital as we do if we were to buy the share, and we could trade more contracts, right? So that will compound into more profits if the position is favorable for us. Okay, but conversely, of course, if it's going against us, then it could mean more losses. So it also goes both ways. Okay, so in terms of the capital that we use, it would be different as well, right? With stocks using more capital and options using less capital. Now, on the other side, in terms of expiration, the stocks never expire, right? So if we were to buy the shares and we hold, then technically we are owners of the company forever, unless the company shuts down, right? It goes bankrupt and the shares become worthless. Otherwise, if we assume a company that's listed on the stock market to go on forever, to exist forever, then we continue to be the owners for as long as we live, and we can pass on the shares to our descendants, right, as inheritance. So in that case, we are able to pass it on forever, right? So it's a permanent asset in that sense. On the other hand, for the contracts, right, the option contracts, no matter how long the expiration, we could be looking at a contract that is 1 year out, 2 years out, there is still an expiration date attached. So it could be 2 years later, 1 year later for a longer term contract. It could also be next week, next month for a shorter term contract. So with the expiration, then there is this problem of the tether. right, or time decay. So for contracts that are expiring faster earlier, the theta, the time decay of the contract will be larger in value. That means every single day that passes, the contract will be losing much more in value compared to the contract, right, that is a longer term. So if it's a longer term, then every passing day is just one day out of the many, many days that still remains with the contract. So then the time value will be much less compared to a shorter term contract, right? And for a buyer of a contract, right? For a buyer of a put contract or a call contract, time is always against us, right? Because we have to close our position before the contract expires, before the time decay it becomes too serious, too high that it erodes our profits. Okay, and of course, for a seller of the contracts, right, then time is on our side, right? So we may leverage on the decay so that we gain more profits as well. In terms of the complexity, I would say that for stocks, it would be simpler, in my opinion, because with the stocks, we are simply looking at just the company's performance. Right? So we're looking at the company's performance, we are looking at how it's performing using fundamental analysis, right? Looking at its business model, any news that happens, any updates that happen, and also looking at the technical analysis, right? The stock charts to see the stock is moving in a certain direction, if there's any trend that we can observe, and so on. So this is what we do if you're trading the stock itself. But if you are trading the option contracts, then you are doing this, and also you are choosing some variables with the option contracts, right? For example, now that you see that Tesla is moving upwards aggressively, right? And it has been for the last few days, for example, and you decide to take a long position, right? So you're going to go buy a call contract, call option contract. So in that case, we ask ourselves, are we going for the short-term contracts? Meaning, are we buying next week? Are we buying 1 month later, 2 months later? Or are we interested in a longer-term contract such as 1 year later, right? Because the expiration date will affect how long we can afford to hold on to this position without significant time decay loss. That's one thing. And also right, we need the stock to move in that direction so that we can close the position. Because if Tesla were to continue moving upwards, both call contracts, whether short-term or long-term, will stand to benefit. But if Tesla is going to take 1 month to go upwards to our target price level, then if a contract that's going to expire next week is not going to be in time to catch this move. Whereas for a contract that is longer term, we have time to catch this move. So there's a weighing of the decision there, right? Whether we're going for a shorter term or a longer term contract. Of course, the trade-off is that with a shorter term contract, if the price is moving up very quickly, then the increase in the option price or how much profit we can make will be much more exponential with the short-term contract, right? Because it's more volatile and there's more profits to be made the short-term traders. So that is the trade-off that we have. Then on the other side, apart from choosing the time, there's also the issue of the strike price. So let's say right now, Tesla is trading at about 150, for example, and a near strike price, right? A strike price that is near 150 could be a 155, 160, and so on, right? Contracts that are nearer to the actual price of the stock will tend to be priced higher, right? Because there's a higher chance that the stocks will actually reach the actual price or will reach that strike price of the contract. So for example, if we are looking at a call option, right, with a strike price of 155, right, that means if we buy the contract, right, then we are able to buy shares of Tesla at $155 per share. And right now the actual price could be 152. Then there's a high chance that Tesla will go to 155 or even go beyond 155 within a short period of time. So this contract with the strike price of 155, 155 will be much more valuable than another contract that is at a strike price of say 200 or 300, right? Because it will be much less likely that Tesla will reach the price of 300, right, in the same period of time, because the move is going to be much more. Okay, so in terms of strike price, the closer it is to the actual stock price, it is of course more expensive. And the further away it is, right, or we call this out of the money contract, it will be cheaper, right? So in that case, how do we choose which strike price to buy, right? Because if you choose a nearer strike price, then if you're a buyer, it's going to cost you more. But when the stock moves, then it's going to give you more profits, right? Compared to a strike price that's further away, it will be safer for a seller, because for the seller, they may just want to collect the premiums, right? And they don't want to have the contracts being exercised, so that they have to buy the shares or they have to sell the shares. So in that case, further away the strike price is, it is less likely that the contracts will be exercised. And in that case, the sellers may prefer this safer approach, right? So for the buyers, they may not want, or for the buyers, they may be assuming that the stocks may move aggressively in certain direction. They could spend less money to buy the contracts, right? An out of the money contract. And then after that, once the stock move in that direction aggressively, they may make more profits. Okay, so you can see there is a lot of things to consider, because for contracts, you have to look at the expiration, you have to look at the strike price, you have to consider the Greeks as well, right? The theta, the delta, and so on. So there are many things to consider, and all this may have to be made in a split second, right? Because the moment you identify that the stocks are, say, moving upwards aggressively now, and it looks like it's likely to keep going up, then you may want to enter into a call position in this few minutes time, all right, or within this minute. Then you have to make the decision of choosing the strike price, the expiration, and all that, right, within that short time frame. And if you take too long, right, then the shares may have already gone up a lot before you actually go in, and the room for profits may become less as a result. So these are some of the things to consider, and the differences between the stocks, the option contracts. Then the last part I would say is in terms of the risk management, right? Risk management, there are many ways to look at this, right? So it could be in terms of planning a portfolio, right? As to not allocate a big portion of your portfolio to just that one, two concentrated positions, so that you avoid being pulled down aggressively when the stock or option move against you. So if with a stock, if you want to see substantial gain, you may need to buy more shares. So in the same example of Nvidia shares, if we were to buy 100 shares, right, it would likely take up a bigger proportion of our portfolio, right? Because it would take about 12,000 US dollars, right, just to buy 100 shares, and that will occupy a lot of cash, right? And when the shares drop in price, we're going to see a big substantial fall. Conversely, if you want to ride on the wave of Nvidia moving upwards, we could buy call contracts. And the same call contracts, even if it's at a longer expiration, it could cost about $1,000 or $2,000, right? Depending on the strike price and the exact expiration. So $2,000 in the context of 100,000 US dollars portfolio, right, is just about 2% of your entire portfolio, right? So even if the position moves against us, right, our risk will be much more contained. Suppose in both cases where we buy the shares and when we buy the contracts, right? Let's say both go down drastically to the price of zero, then in one case we are losing 12,000 and in one case we are losing 2,000, right? So we are able to manage our risk. Okay, but of course, you have to look at the other factors, right? Like the stocks may not go down to zero because they would probably be worth something, but the contracts could expire and be worth zero, right, by the expiration. So that's something to take note of as well, right? But it's a smaller cash outlay, right? So you may be able to mitigate the risk in that sense. Okay. Then in another perspective, contracts, the options contracts can also be riskier because there's always this element of time decay, right? So if we have all our contracts, if we only have all options contracts in our portfolio, then we may need to monitor more, because especially if we are the buyers, right? If you're the buyers, then the time decay could set in and the contracts could go to zero, right, by expiration date, especially if it's more short term. For the sellers, right, if you're selling many contracts, then you're creating more obligations for yourself, right? So when we sell a put, we are promising to buy 100 shares at a certain price by a certain date. And we need to make sure that we have the cash in order to buy these shares. Okay, otherwise, we may have a margin call, right? They may liquidate our position, and that would not be good, right? Because we may be incurring losses at that point in time. So then in that case, it would be wise to actually manage our position well. Okay, so hopefully this episode has shared some points, right, in terms of the differences between trading stocks and trading options. All right, so I'll see you guys in the next episode where we talk about the other aspects of option trading.